We are living through interesting times. The first people recognize that we might have already entered the bear market, that this might have been it. But is that actually that straightforward? Let's have a look at some data most people aren't considering. Let's see where a potential bottom might be or if we should exit altogether. Now, over the course of this year, Bitcoin has actually not gained that much. We are up only 18% because we've already fallen from 106K all the way down to 82K. Are we going to fall further? Now, there's something happening that not everybody is aware of. Since August of 2022, so in the last 2.5 years, Bitcoin tended to outperform most other altcoins. So the Bitcoin dominance went up from 38% all the way to currently 61%. And historically, we tended to peak at around 70%, a bit more than that. So that means that all of the trading that we saw in the meme coin space and that we saw in the artificial intelligence space, all of that rally actually did not have any impact on the overall altcoin market. Altcoins as a whole still underperformed Bitcoin. And that's not just in the last 12 months, this is a pretty long-term trend. And I do believe that this is likely going to continue, at least for the foreseeable future. Now, I am always interested in market structure because market structure can give us an idea of what kind of sectors we should be betting on, right? If the Bitcoin dominance tends to rise, then we should be over allocated to Bitcoin. But what we can also look at is what kind of altcoins, as in what altcoin size tends to outperform. Should we bet on the top 100? Should we bet on the very small tokens? What tended to actually do better in the last year? And the answer is over here. It's an overview table on cryptobubbles.net. So this shows us the performance in the last year for the top 100 tokens, the top 100 to 200 tokens, etc. This is ordered by market cap size. So the top 100 in the last year actually didn't do that well, right? They performed worse compared to Bitcoin. Again, as a reference, Bitcoin made 18% in the last year. However, the tokens between place 100 to place 200 and place 200 and 300, they still performed relatively well. The very small tokens, they did rather poorly. Now, there is an outlier from 900 to 1000, but it's truly just an outlier because we've got this Zypto token that is still super small. After a rally of almost 100,000%, it's still at 12 million. So pretty much nobody made money with that. Excluding that token, the very small crypto category also didn't do so well. So in aggregate, the smaller we go, the more the odds tend to be against us. The sweet spot seems to be with the altcoins between 100 and 200. But still, even though this category outperformed Bitcoin slightly, right, by 10 percentage points in the last year, the returns are still extremely concentrated. The vast majority of altcoins did worse. Only if you were invested in the virtual protocol or in SPX 6900, you made bank. If you didn't do that, then you're very likely not doing that well. And so fundamentally, how I think about this is it makes sense to hold Bitcoin long term, potentially even hold it over the cycles over many years, more than 4 or 5 years. But for the altcoins, it's rather sensible to trade them short term. So when we are in a bull run, simply just take the current momentum. But when that momentum dies down, selling quickly makes sense. Because let's even look at SPX 6900 and at the virtual protocol in the last month, they did not perform well either, right? They went down. So that's 45% for virtual and 33% for SPX 6900. And that's way more than what Bitcoin lost during the same time period. So really, altcoins are something to speculate with when we are in a clear bull market, which currently is not the case. Now, I believe most capital was not necessarily lost with the AI coins and with meme coins, because usually people just bet very small amounts on those tokens, right? Those are asymmetric bets. So we pretty much buy just lottery tickets. We put maybe $100 in such a lottery ticket, hope for this to 100x. And if that doesn't happen, fair enough. But I think most capital actually got lost with Ethereum because here the bets tend to be way higher. Many people have Bitcoin and Ethereum as their main bets in crypto. And what we see here is the Ethereum dominance. And over here, this was the move from proof of work to proof of stake. So since Ethereum changed its fundamental mining structure and incentive structure and tokenomics, it did very poorly. And in the last year, Ethereum underperformed the rest of all of crypto by roughly 50%. And we might even fall a bit lower. The question is, what happens then at those levels that we saw end of 2019? Are we going to see the bounce? I think it's possible, but right now it's still quite risky to get into ETH. The momentum is clearly extremely bearish. The loss is pretty much accelerating. And so again, does it make sense to sell now everything because most altcoins underperform and because Bitcoin tends to hold up comparatively well? I think it depends on your time horizon, because have a look at this. This is the stable coin market cap, and this tended to trade in a range for the last 1.5 years. And we are rather at the upper end. Now, the stablecoin dominance is a measure of how risk off people are. So when a lot of the cryptocurrency market cap is in stablecoins, that's when prices are low and that's when we want to buy. The exact opposite is true when the stablecoin dominance is low. That is when Bitcoin makes new all-time highs. That's where we want to sell. And we've seen a lot of de-risking since the beginning of December of last year, and maybe we can be turning around again. It could happen today, it could happen in 2 weeks, but yeah, this higher level in the stablecoin dominance is a potential buying opportunity. The question, of course, is always what to buy, because returns are just concentrated in a few altcoins. But let's take one more step back here. The Bitcoin ledger started in January of 2009, and that was at the peak of the global financial crisis. So what we've got over here is the Shiller PE ratio, or the historically averaged 7-year price to earnings ratio of stocks. This is a very long-term chart, right? It starts in 1871. So this basically shows us how expensive it is to buy the future cash flows of publicly listed stocks. We are historically pretty high, and we have been historically pretty low when Bitcoin started. In other words, Bitcoin has never really seen a real crisis since its existence. This over here is the dot-com bubble burst. This over here is the global financial crisis. This over here is the Black Friday, right? The Great Depression. And what we've got over here, that's the oil crisis. And so Bitcoin was born out of that global financial crisis, right? In the spirit of the global financial crisis. Because the way the governments and the central banks were dealing with monetary policy at the time was a problem. This is how Occupy Wall Street got started, right? The movement against Wall Street, that was also embedded in the launch of Bitcoin. A lot of value was transferred to rescue the banks, to rescue the financial system, and that obviously increased quite a bit of moral hazard, and it devalued the money for everyday people. Bitcoin was the answer to this, right? We don't want to get our hard-earned money devalued. That's where the 21 million cap for Bitcoin supply comes from. And so here is US money supply. This is how quickly the monetary base is increasing. Since the launch of Bitcoin, it went up by 160%. Here's the same chart on a logarithmic scale, so we can see how the monetary expansion is pretty linear. It doesn't fluctuate too much. Yes, there are decades of slightly faster expansion and other decades of slightly slower expansion, but overall this is a pretty constant chart. This line over here implies monetary growth of 6.8% per annum. So the official inflation numbers of course tell us that money devalues slower than that, but the monetary base is expanding faster. And so Bitcoin has served its purpose. This is the Bitcoin price, very long term. This is the Bitcoin price relative to monetary expansion. So Bitcoin did outperform monetary expansion very quickly at the beginning. Now not that quickly anymore, but still we do see an outperformance. This is when Bitcoin was at 20k, right? Then subsequently went below 4k. But from that top, right, from 20k all the way to today's prices, we have still seen Bitcoin outperform monetary expansion. There is a lot of volatility, but overall we do get protected from the money printer. There are other assets that also work against monetary debasement. What we've got over here is the Nasdaq 100 relative to US money supply. So this chart starts in 1985, and again, long-term technology stocks tend to do better than monetary expansion. This big rally and subsequent crash, this is the dot-com bubble burst. But still, we recovered from this, and it looks like very long-term, without all of that exuberance, we tend to see technology stocks doing better better than monetary debasement. This is just another way to show that over time the economy concentrates more and more towards tech. So tech eats up more and more of the rest of the economy, which is intuitively pretty sensible. The economics of technology companies tend to be better long term than the economics of all other companies because we can scale globally for pretty much zero cost. Traditional businesses have to build new factories and hire more people. That's not really needed for technology business models. By the way, when we look at all of US stocks, we don't necessarily see that long-term outperformance. This is the S&P 500 relative to monetary debasement. Again, this is a very long-term chart. It starts in 1959. And yes, one could argue that there was some outperformance of roughly 42%. But then, on the other hand, this is where Bitcoin got launched. And historically, the PE ratios are very high right now. They might come back down to 25 or maybe even 20. And if you do that, then the S&P 500 pretty much goes just in line with monetary debasement. But yeah, Bitcoin is able to outperform monetary debasement, and so are technology stocks. But here's something that's not so obvious. This is the Bitcoin price relative to the Nasdaq 100. And of course, at the beginning, when there was a lot of Bitcoin adoption, it outperformed the Nasdaq 100. But in the last years, this was not necessarily that obvious anymore. Bitcoin over here again was at $20,000, and it did outperform the Nasdaq 100 if you compare to today's price, but not by much, right? By only 32%. If you're just falling to 70 or to 60K in BTC, then BTC will have returned the exact same as the Nasdaq 100 since the end of 2017. So in the last 7 years, roughly. Isn't that fascinating, right? Way more volatility with Bitcoin, but very similar returns to technology stock. I'm simply just presenting data, right? You have to draw your own conclusions from them. But if we just look at the long-term Bitcoin chart and we just use those curved lines, it's nothing scientific. It's just lines that historically connected the bottoms pretty well, but also the tops pretty well. If we take that as a potential trading range, and of course those lines can break, but if we just take that, then the current potential risk versus the current potential reward isn't really that great, right? We could, in theory, fall all the way down to 40K. At least historically, that's the kind of volatility we have seen in the past. And I already hear the arguments. Whenever I show charts like this, right, long-term charts and trading ranges of Bitcoin, many people say this time is different because of the approval of the Bitcoin ETF, because now Bitcoin has legitimacy. But I'm not sure if this is actually true. I do not believe that the Bitcoin ETF has enough impact on the price to change the cycle. Yes, the ETF flows do have an impact on price. As in when we look at this chart, which shows the ETF flows on the x-axis and the 7-day average performance on the y-axis, there's clearly some kind of correlation. I don't know the R squared of a potential regression line here, but it's definitely not zero. There's some kind of pretty appropriate fitting here. But have a look at the ETF flows daily. So that's this dotted line in black. Sometimes we see inflows, sometimes we see outflows. And in the last weeks, where we tended to see Bitcoin's price going down, we did not see any inflows whatsoever. So the Bitcoin ETF flows are far from being constant. We sometimes do see selling. There is correlation. Wall Street is not just always buying. Wall Street is also following the trends. And if people think that currently the price is expensive, then we also see selling pressure from the Bitcoin ETF. We don't just always see accumulation here. Here is what I believe is partially causing the cycles. This is the long-term holder supply chain. So the long-term holders take profit whenever Bitcoin rallies and they buy in whenever Bitcoin dips. And currently the long-term holders tend to still slightly sell. Now have a look at the ETF change. Most of the time we do see a bit of inflow. So this is net a positive for Bitcoin. But in the last few days, we tended to see negative flows. We tended to suddenly flip. But what's more important than this flip here is really the magnitude of how much the long-term holders count versus how much the ETF counts. The ETF really doesn't change the fundamental dynamics of Bitcoin. And with fundamental dynamics, I mean simply reference prices, portfolio weightings, things of that nature, right? Human psychology. If you have, say, 20% of all of your money in Bitcoin, and then Bitcoin's price doubles and triples because you bought very low, then do you really want to have 50% of your wealth in Bitcoin? Bitcoin has rallied a lot, so it might crash down. At the same time, you have a risk tolerance of maybe 20% that you have maybe when the price just crashed down, right? So you think Bitcoin is cheap. You want to have as per tendency less exposure to Bitcoin when it has already rallied. So when you've got 20% exposure at the bottom, when it then rallies up, you want to have maybe only 10% exposure, not 50% that you automatically have by just holding. And because of that effect, I believe the long-term holders sell during a rally. And because of that effect, it's important to look at the reference price. So when you buy an asset, say Bitcoin, or you buy a house, or you buy whatever, right, stocks, when you buy something, you always look at the future prices relative to your purchase price. If you believe in the asset long-term, let's say you buy Bitcoin and you think that Bitcoin is the hardest of the monies, you want to hold this long-term, you believe in Bitcoin, but Bitcoin's price is going down relative to where you bought, you might simply consider holding, potentially even buying more, right? You're not going to sell at a loss if you don't have to. However, when Bitcoin goes up relative to where you bought, you might consider rebalancing again with the example that we just made a second ago. So it's very important to look at the market in aggregate. Where is currently the reference price? Where did the market in aggregate buy Bitcoin? And that is this chart. It's the realized price. It shows us where in aggregate the market has bought or sold their Bitcoin. And when the market in aggregate is in losses, the selling pressure tends to go down, and it tends to be a very good time to buy. When it's in profit, it might make sense to sometimes take some of that profit. But again, it's especially good for buying opportunities. And we are not yet very close to the realized price. It's at 43,475, which interestingly enough isn't very far away from this bottom that we just drew on this chart. Fundamentally, the way I look at this is, I want to be risk on whenever we are very much below the realized price. I want to buy Bitcoin, potentially also some altcoins that have some kind of inherent leverage, even though the altcoins, of course, is always a bet against the odds because most altcoins tend to underperform Bitcoin even during a bull run. When we are, however, above the realized price, then I'm always considering when does it make sense to potentially sell, when does it make sense to potentially rebalance the portfolio. Now, currently we are above the realized price. We tend to have negative momentum. The price tends to trend down, at least on the medium term, maybe not in the next 1 or 2 weeks, but probably over the next 1 or 2 months. And because of that, I'm adjusting my strategy as well, right? In the bull market, I was tracking wallets. I was looking at other influencers. I was looking at what are they buying. I tried to buy together with them before they promote this on their channels. In a bear market or in a market where we simply go sideways, I want to bet on falling prices. For example, check this out. This is the Chainlink price, and there are 2 markers over here. This is where I opened a short position. This is where I closed a short position. So it's all about getting the macro right and then finding the right assets that give us the best leverage on the macro picture. It's important to have a strategy during falling prices. So Chainlink went down by more than 40% during that time period. Here's the announcement on January 23rd, how I shorted Chainlink. Here is the announcement on March 4th, how I closed the short position. And that's all part of the premium membership. So the link is down below, thebitcoinstrade.com. The reason why most people don't have a strategy for the bear market, why most people just exit crypto, is because betting on falling prices can be a bit scary. It's important to have this set up in a way that we don't get liquidated, that we still have acceptable risk within our portfolio. The execution of a trade like this in itself can be a bit daunting. And because of that, I made a lot of tutorials on the topic. So again, this is all part of premium. There's more than 100 tutorial videos in total. It's about risk management. It's about diversification. It's about shorting assets, what kind of assets to select in order to bet on falling prices. But the nice thing about all of this is, again, the odds are in our favor. If the macro is not clearly bullish, most altcoins do very, very poorly. But even over the course of this year, where Bitcoin went up by 18%, most altcoins are in the red. And again, betting on falling prices is getting the odds in our favor. We're not trying to find the needle in the haystack. We're not trying to make the 100x return and lose everything. Instead, we bet larger amounts and get consistent alpha with compounding. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you don't like premium, just message me within the first 7 days and I'll refund you 100%. There's really zero risk for you. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you again on YouTube or see you in premium. Cheers.